Hi, Daniel Kertcher, CEO and founder of Trading Pursuits, and this is my global market update for November 2012. Now before we get started, there's just a couple of little disclaimer things I need to share with you. Number one, what you're seeing today is what we call general advice. It's not individual specific advice. Furthermore, we haven't taken into consideration your own personal financial objectives. Trading involves risk. Should you choose to make any trades, those are your own decisions and you take your own risk. And finally, my company, Trading Pursuits, we hold an Australian financial services license. Okay, well this month we've seen the finalization of the top 500 companies in America making their earnings announcements. And that of course is every 3 months the top companies, or all public companies for that matter, have to make their profit and loss statements. And what we can see here is that for the top 500 companies in America, almost every single one of them has now made their earnings announcement, and we've seen that there's been an earnings surprise. That is, close to 3.69% of the top 500 companies have had greater earnings than expected. However, if you look next to that, you'll see the sales surprise has actually been lower. So what this simply means is that companies have been making less sales, less revenue than expected, but actually greater profits than expected. So that could be through cost cutting, laying off staff, improving modernizations of their factories, etc. So it's a good sign that companies are growing their profits, but analysts are pretty spot on with the amount of sales that they're expecting companies to be making right now. Now, despite this seemingly good news, the US stock market has had a substantial drop in the last month. Now, of course, in the last month, we of course are aware of the US government election won by Barack Obama. Now, in the last review I did last month, I mentioned that the market was going sideways in a lead up to that decision, that election. Now that we've seen the results, I suspected that the market may have just continued moving in the same trend it was on before. However, following the election, we had two major announcements. Number one was the European drama, and that is the European credit crisis has flared up even further, and further talk of what's known as the US fiscal cliff. So what we can see is that in the last month or so, the S&P 500 value has dropped close to about 100 points. Now, the overall index itself is still up over 100% in the last 3-4 years, but it's dropped 8% in the last month alone. Now, it's back down to about 1,350 points. As you can see from the graph, it could easily fall back down into the 1,200s or even 1,100s level. So what are we talking about these two particular points? Well, despite the fact that US unemployment is still in a downwards trend, which is good, it's still quite high, up near the high 7% range. Now, the European debt crisis problem, this has again flared up with, again, Germany, France, Greece, Spain, Portugal, Italy, etc., struggling to come to agreements to deal with their European debt crisis. What we have seen, though, in the last couple of days, though, is that there has been an extension granted to Greece. And that is they have an additional 2 more years. And Greece has only just, literally recently, announced that they've passed their austerity measures. So Greece is doing the right thing as far as the rest of the European Union is seen. They're improving their austerity measures, they're reducing their costs, reducing their expenses, and at the same time having given more time to get their house in order. Now this is good news, but leading up to it has caused the market to panic and we've seen a big drop. Now, in addition to that, we have the US fiscal cliff. Now, the US fiscal cliff is nothing new. This is something that's been around for many years. So, what is the fiscal cliff? Well, basically, as you can see here, the fiscal cliff is essentially a date and time that's coming up in end of December 2012, where a lot of the George Bush era tax cuts, those tax cuts that the last president gave to particularly the wealthiest people of America, those tax cuts are set to expire, as well as a variety of other tax cuts and tax holidays. So what that means is that the government's going to be cutting back on their spending, but at the expense of the taxpayers and at the expense of the economy. So there's a big concern then that with these tax cuts it's set to take place in just over a month's time, that could substantially decrease the value of the overall market and slow down the US economy and hence the overall recovery. Now that fear has been built into the market and we've seen the stock market fall quite strongly in the last month. Now, we haven't even got to this point yet where the fiscal cliff date. The lead up now, of course, is what are they going to do? And there's a whole series of different things they can do. They can actually let all the tax cuts go through. The benefit of that is we'll have the deficit. And if we have a look here, this is the US debt clock. What we can see is that the current US national debt is up around $16.2 trillion. To put that in context, it was about $8 trillion 4 years ago. So it's literally doubled in the last 4 years. Now, the US budget deficit, that is the difference between what the US government takes in taxes and what they spend in expenses, the shortfall is known as the deficit. And as you can see, it's over $1.1 trillion. Now, if they let all the fiscal cliff tax cuts take place, then that will have the deficit next year down to about $560 billion. But at what cost? An alternative would be to postpone the fiscal cliff and just dole out the tax cuts for another year or so. That doesn't solve the problem, that just kicks the can down the road. Alternatively, they can come to some sort of compromise in the middle. Now, the big problem they've had is the Democrats and Republicans have not been keen to compromise in the last 4 years, especially with Barack Obama as president. So I have heard through the media that the Republicans and Democrats are prepared to try to work together to deal with this problem now, but we'll see what happens. What we can be pretty much assured of is that we're going to have quite a bit of volatility and quite a bit of fear in the market over at least the next month while we come to this realization as to what are the US Congress going to do. Now, when there's lots of fear in the market, we see the demand for bonds rise. And we can see that clearly in the last month. The US government bond prices have been rising back up again because they're seen as a safe haven in the market. And because the overall global economy may slow down due to the tax cuts in America, then the oil prices also drop back down from about $100 a barrel 2 months ago down now to only about 86. So quite a substantial drop percentage-wise. The overall commodity market, this is a combination of oil and gold and copper, lumber, soy, corn, a variety of different commodities all squished together into one overall index. We can see too that global commodity prices have been falling in the last 2 months, again, due to the fear of a slowdown of global economic recovery. Now, the Aussie dollar, it's been going sideways. Why? Because even though commodity prices have come down, Australia still has the highest interest rate of all the major nations in the world. And so that creates a demand for the Aussie dollar for forex traders to generate and return from interest. So we'd have to see commodity prices really drop and interest rates in Australia really drop pretty much in order to see the Aussie dollar fall back below parity against the US dollar. And finally, the Australian stock market. Pretty much when the American market falls, the Aussie market is likely to follow suit. And that's exactly what we've seen in the last month. The ASX 200 has dropped back to about 4,350 points. That's a drop of about 5%. So not quite as big a percentage drop as the S&P 500 in America, but still a pretty big drop. And as you can see from the graph, there's still quite a bit more movement. This graph could easily fall back further. So, as I said, right now, the market's very, very nervous. We could have some great deal of volatility driving the market back down over the next couple of weeks. However, if we start to see some certainty come out of America regarding the fiscal cliff issues, then we could see a stabilization in prices and potentially even a rebound. Now, I hope you've enjoyed this session. My name is Daniel Kertcher. May I wish you profitable trading.